Charles Schwab saw staggering growth in January, reporting that it had added over 1,000 new brokerage accounts. By the way, that's up 200% over the same time last year. Total client assets ballooned to more than $6.7 trillion. That is a 67% jump from the same time last year. Michael Santoli, we've talked about the free trading stuff for a while. Robinhood's synonymous with it, but all of the brokerages offer free trading right now. How much has the day trading mentality permeated investing today? Does it feel like 1997 to 1999?
It definitely feels like it in terms of this source of energy coming from the broader public, a little more excitement around certain types of stocks that seem intuitive to this group. But absolutely, it rhymes. What is surprising to me to some degree is the difference that zero commissions made. I mean, I was around covering the very dawn of online brokerages in the 90s, and everyone knew the commission rates were going to be going down steadily over time, and they did. But when they got to $5, you would hear the people in the industry say, hey, the average trade side's $10,000. What's the big deal about paying $5 in a commission? Well, guess what? If you want to get people who want to buy fractional shares and have smaller accounts but are excited to trade more, this is what did it. So the pie's growing big enough for everyone to get a piece. And, of course, Schwab, been there a long time. A lot of that asset growth is from the market, but it seems like a thriving moment for the industry in general.
Robert Frank, I mean, you cover the really, really rich people out there. How big of a deal is it that there's a, so to speak, democratization of the industry, that investors are now not just like the millionaire types, but you can actually get in because of things like zero commission trading and of course, fractional share ownership as well?
Yeah, Dom, this is long overdue. You know, the stock market is the wealth engine of America, and unfortunately, too many families were left off that engine and were not attached to it. The top 10% own 88% of the stocks in this country. And by the way, those numbers just haven't changed in over 20 years. So the fact that we finally have new investors, many of them young investors, coming into this market, hopefully going from being traders to long-term investors, is what we need. Now, what we do need now, in addition to more investors, is less gamification and more education about investing.
All right, so a big deal there for Charles Schwab, still following the big surge in retail trading. Next up here, if beauty's in the eye of the beholder, then the future is looking gorgeous for the beauty industry overall. The world's largest cosmetics maker, L'Oreal, is predicting a 1920s-style boom ahead for its market at an investor conference. L'Oreal CEO said the recovery will be the fiesta of makeup and fragrances. His words. This as L'Oreal reported better than expected revenues thanks to strong Chinese sales and robust growth thanks to skincare products. Other beauty companies have also been performing handsomely, if you will. Coty, Ulta, Estee Lauder have all more than doubled from their 52-week lows. Rahel, you cover many of these companies. I know you've been sitting in on some of those earnings calls as well. The big deal here is it a resurgence for health and beauty, or has it just been around all year long and we just haven't really seen it?
I don't know if it's a resurgence quite yet. I think where we're really seeing growth, Dom, is skincare, which you just alluded to there. Makeup sales had been sort of declining even before the pandemic, and the pandemic sort of accelerated that because most of us were home, but maybe you were on Zoom calls. But skincare, I think, is really where it's at. In fact, we heard the L'Oreal incoming CEO saying that's going to be his top priority when he assumes the position a little bit later this year. Also, not just skincare, Dom, but what companies put in their products, clean products. That's something we heard from Coty earlier this week, that they've been seeing really strong sales with the CoverGirl Clean strategy. So I think, I'm here for a fiesta of fragrances and makeup, and I'm certainly here for a bold lip. But I think skincare has definitely been accelerating. Sales have definitely been accelerating in the past few years, and we'll likely continue to see that because, Dom, I don't know about you, but, wearing these masks, now we have to deal with maskne. That's a whole other issue. Certainly skincare, very important for that issue, but I know a lot of people can relate.
Well, so Robert, every time I hear about the roaring 20s, right, and this is not the first industry or CEO that's made an allusion to the idea that we could see a resurgence like the 1920s as people kind of emerge from the pandemic. But in your mind here, how much can it be that much like the roaring 20s? I think Great Gatsby, I think of all these, flapper type parties and everything else. Is it really going to be like that once COVID is kind of eliminated from the equation?
Well, let's look at China. So what's been important to all these fragrance, makeup, and skincare products has been the comeback in China. I think L'Oreal had 27% growth in China in the most recent quarter. And China is what consumers could look like after the pandemic here. And what we've seen there is what they call revenge spending, where people are so tired of being cooped up and not spending that they went out. And the luxury industry is booming in China. All roads in luxury lead to China right now. And part of that is because of demographically what's happening in China compared to an older U.S. But I do think that China is the north light of what luxury could look like in this country and in Europe once we're out of this.
All right. I mean, it was one of the things that we talked about probably in April or May of last year. If you were looking for a leading indicator of what things could look like, it could be China because of the recovery over there. All right, next, let's go somewhere warmer. I want to go someplace warmer, without taxes, perhaps. The ongoing migration to Florida is turning the luxury real estate market there into one of the hottest in the country, if you haven't already heard. In fact, the most expensive home ever sold in Florida just closed yesterday. Forget this, over $130 million, just down the road from billionaire investor David Tepper. Robert, I know what the allure of Florida is, but how hot can it get down there for the real estate market?
Just when we think it's peaked, it just gets more incredible. So if you look at Palm Beach, which literally has run out of mansions to sell, David Tepper, the home that he bought or is in contract for $73 million, that home wasn't even for sale. And what I'm hearing brokers saying is they have to go around and knock on doors to find homes to sell. Scott Schleifer, who bought the house for over $130 million, that was a spec house, just came on the market in January. Prices in Palm Beach are up over 50% last year. Sales contracts in January more than doubled. This shows no signs of slowing, and that's because what used to be a millionaire migration is now a billionaire bonanza. And the wealthy, they just follow each other, especially those who are wealthier than they are. So I think this is going to just pick up steam.
Mike Santoli, there have always been reasons for people in the Northeast, specifically New York City, to be in Florida. In fact, some people split their time. Is this one of those moments where we could really see Wall Street down on South Beach?
Yeah, I don't know to what degree we have to move the infrastructure. I mean, right now, you do actually have hedge funds already set up down there, right? Remember, Citadel famously set up, I believe, in Palm Beach. So I don't think there's any impediment to it. I do want to say, though, let's knit this together. There was a Florida land bubble in the 1920s. I mean, people really did. It's always been the repository for the wealth that spills out of the rest of the country. So it's not surprising to see what's happening here, especially with the tax arbitrage happening.
Oh, he's connecting dots. There's some implications there as well. We'll have to get to that later on at some point down the line. And this is a bittersweet one here for all you candy fans out there. The iconic Dylan's Candy Bar is closing its flagship Upper East Side Manhattan location. The 13,000 square foot store is now listed for lease by Ripco Real Estate. This comes amid a report from Manhattan real estate watcher The Real Deal that Dylan's Candy Bar is being sued by the landlord of its corporate office for unpaid rents. Rents for the retail space in New York City have skid to historic lows. We've talked about this, down 25% from pre-pandemic levels. Rahel, this is another sign of retail apocalypse, so to speak. But is Manhattan indicative of everything else that's happening in the country, or is it very specific to just New York?
You know, it's hard to say, Dom, because I think those of us that live in the city, we live in our own little bubble, and we think that New York City reflects the larger country. But I can certainly say, being in the Upper West Side for sure, that it felt like a ghost town sometimes walking along Columbus Avenue, seeing all of the empty retail space. But Dom, one thing that's been really interesting as well is seeing some of these landlords now sue these companies for real estate. In fact, I saw it earlier this week in Assignment Property Group upgrade. I think it was by Morgan Stanley, but essentially saying that they're upgrading on the potential recovery of about $410 million in abatements. And so interesting to see if we'll start to see more of that as these landlords try to recoup rent. But Simon Property Group, that huge mall owner, getting an upgrade because it looks like they're going to be trying to recoup some of those rents too.
Quickly, Robert Frank, do you frequent the Dylan's Candy Bar in New York City?
My daughters did, but this company was having problems before the pandemic. They're a giant sugar house in a sort of culture that is increasingly health conscious, and it's so overpriced. Dom, would you pay $17 for a container of gummy bears? I mean, I love gummy bears, but $17 you can get them for like $4 on Amazon. So Even before the pandemic, they were having trouble.
Shepard Smith here. Thanks for watching CNBC on YouTube.